Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming from TicketTacker. We're going to take a look right away at the breaking news that came out. U.S. inflation surges to 13-year high of 4.2%. U.S. inflation surged to its highest level rate since the eve of the 2008 financial crisis in April, as last year's collapse in oil prices and a nascent economic recovery combined to generate the kind of number that many market participants have feared. The consumer price index rose 4.2% from a year ago, according to government data released on Wednesday, well above the consensus forecast for 3.6%. However, the 0.8% rise in prices in April alone made it clear that the spike wasn't entirely a result of distortions from last year, when crude oil prices briefly dipped below zero against COVID-19 driven collapse in demand. Even when stripped of some of their more volatile elements, the data were ugly. The core CPI, which includes food and energy prices, rose 0.9% on the month, its biggest monthly rise since the early 1980s. That left core inflation running at a rate of 3%. This pretty much is obviously what the 10-year note was anticipating a while back. So let's take a look and see what the market is doing here. It's up 4 or 5 basis points, 167 ticks. It's up 4 or 5 ticks, up 2.93%. And I think the rates, as I pointed out yesterday, potentially might have bottomed, meaning that they're going to go up, and they're up pretty strongly here this morning. So how do we take advantage of a situation like this? For example, the first thing to recognize is that we are dealing with a very volatile market. Volatility is supreme. Let me take a look at a couple of other markets here. A lot of the other derivatives prices have been pretty much skewed, as this volatility here is just amazing here. That what we have seen here, just in gold, for example, if you take a look at the recent action, we went down all the way to the buy one level of 1823, activated it and reverted right back up. When it made a new high from 1823, 22, all the way up to 1845 within a matter of a half hour. So you want to, as a self-directed individual, you want to be very careful about how you trade this incredible volatility, particularly if you're doing the futures contract. So let me take a look here where we are right now. Even though we've seen this gyration, the market has activated a buy trigger point from the B2 level in the gold market of 1823.30. 1808 was the buy 2 level. So it only came down into that buy 1 level that the algorithm pretty much identifies the probability factor to be at a 50-90% relative to the implied volatility to the mean with a one-to-one factor. And that means that if the market comes down there, completes the pattern and reverses from that point, the previous pattern has been completed and a new trigger point has been activated. The problem in trading this kind of market, when you see this tremendous volatility, it's really difficult unless you're glued to the screen to be able to take advantage of it. So one of the things that I always look at in terms of positioning myself and what I suggest my traders in my private trading room to use the derivative markets to create a synthetic position that you can cover this potential volatility. Meaning, trading in the futures markets, unless you are well capitalized, even if you do one contract, can be really surprising for you if the market goes against you. So it's a question of how you manage the risk. And what we've been looking for in the last few days is a reversion back down into that B1, B2 level here. If you take a look at some of the videos that I've done in the last couple of days, I've recommended that if we get a reversion back down into that B1, B2 level, that is the place for you to cover your shorts, to cover pretty much any bearish strategy that you might have taken or protection that you might have taken, which is, part of the process. What happens when you get this kind of a move in the market that the volatility is just tremendous. When you take a look at the just on the gold, and even on the silver market, you're looking at 27.18. And the silver market as well saw this increase in volatility. Now, what does that tell us? Well, I think the fundamental picture in the market is verifying pretty much that we are in a bull market, and as many may think that inflation or higher interest rates are going to be needed to monitor inflation, I would say in a normal market conditions, and these are not normal market conditions, the relationship is inversed to interest rates in gold. Interest rates go up, gold comes down. Interest rates going up means the cost of money is going up. It's also supported for the dollar in an artificial way. And obviously it's not bullish for the stock market. So these are the intermarket relationships that we are dealing with right now, and trying to recalibrate themselves into this environment that we moved in, which is trying to find a way economically as far as monetary policies are concerned. The anomaly that I see and that I observe every time that we see this economic indicators confirming basically that inflation is running high and we're above expectations. So it's a question of now how the Feds are going to handle interest rates in order to contain inflation, which is above the objective that they have for inflation, which is about 2% or under 2%. That's according to the CPI that has the formulas right now, basically eliminating energy and eliminating food and energy basically out of the component. And according to the CPI, including all of those indicators, we're running at 9% inflation rate. So obviously, the fact that we got the confirmation that using the current Fed's formula, inflation is showing at 4.2%. It's alarming for the Feds, and the question that arises here is, what are the Feds going to do? Are they going to raise interest rates? Or what I believe they're going to have to do is essentially implement yield curve control. And I've been talking about yield curve control here for a little while because, in fact, what they needed, for what the economy needed in order for us to come out of this potentially depression that we were moving into, is some inflation. The fact is that inflation is coming back at higher levels than expected. And we talked about the velocity of money affecting that inflation rate. And what we are seeing here is exactly the function of the velocity of money into the system in its consequences. Now, it may be that this is short term, as they would like to say, because everybody's coming back into the economy for the first time, trying to normalize ourselves into some kind of a normal life in here. And this is the result of that velocity of money coming back into the economy. It's been a long time. And the question is obviously, how is this interest rates going to affect the price of gold? What I want to do on this conversation that we're having here is put into perspective that we're not dealing with normal times. In fact, if we look back at the indicators or the levels, we're very much similar levels that we were back into the 70s with regards to inflation is concerned. We had just come off the gold standard, and the market was prone, so to speak, for fiat currencies to create a credit economy, which is what has happened here. The difference is that now we're dealing with almost $30 trillion debt. In comparison to the debt that we had back in the 70s, it doesn't come close. And so, even though with inflation moving up and interest rates moving up in the 70s, the price of gold went up, even though interest rates went up again to 14, 15%. In 1981, the price of gold reached $850, $900 an ounce. And the Dow Jones was trading roughly at about $1,000, $900. It was a one-to-one spread relationship to the price of gold. And we had nowhere near the amount of debt that we have right now. The problem that we have right now is that we have this humongous amount of debt, which, according to the data, is approaching $30 trillion. And that's, over 100% of debt to, you might say, the GDP ratio is ridiculous in terms of maintaining stability for the US dollar and maintaining its intrinsic value, its purchasing power. So what we have seen here short term is a rise in interest rates that's supportive for the dollar short term, and it's bearish for stocks, and in short term it's bearish for precious metals. But when you think about the potential consequences that we are going to have here as a result of this velocity of money, bear with me, excuse me. It's going to put pressure on the Feds to decide what to do with interest rates. And based upon where we are right now, in terms of the debt factor, which really increasing rates puts a lot of pressure in the cost of money. And we are dealing with an incredible amount of leverage as a result of this cheap money that we have. Leveraged, over leverage. And we really, I don't believe, know the amount of leverage that's in the system. Some of the facts indicate potentially over $2 quadrillion in derivatives at risk by central banks as a result of this leveraging. That's a staggering amount, and they cannot afford for interest rates to move up on the face of all this debt. It will be possibly another black swan that will create massive defaults, bankruptcies. The bond market is at risk of imploding if we see interest rates go up on the long end of the market. So I think this is what I believe is a perfect scenario for the Feds to implement yield curve control. And that essentially is allowing the rates over the short term on the 10-year bond to move up according to the market, but cap the 30-year rise in interest rates in order to avoid this potential black swan unfolding in the credit markets as a result of interest rates moving higher. Now, this, I believe, would be explosive for the gold market. Outside of the Feds implementing this policy, which I believe is inevitable, if we continue to see this pressure of the velocity of money moving into the system, I personally think that this is one of the ways that, or one of the tools I believe that they have left. And that would be setting pretty much the fire in the price of precious metals. And that is probably the last thing that precious metals, gold and silver in particular, are waiting for. The copper market is just continuing to move higher. Now, one of the products here that I've been keeping an eye on, which is another economic indicator, is the price of lumber. And the last couple of days, the price of lumber has pretty much reverted down. So it could be making a top. It could be making a top. I'm going to take a look and see if I can show you a chart. It's not a liquid market. It's not a liquid market, but it is an indicator of the price of lumber, which is essentially, the cost factor in construction, obviously, that makes an impact as far as rising prices or lowering prices. So we try to get it's about 1597 right now. And it's up a little bit this morning, but we've seen the price begin to turn, as you can see here from that 1700 high that we saw. And if we continue to see a downside pattern unfolding here, I think it's going to be a matter of maybe 30 to, I would say, 60 days before we begin to see the impact in particularly in home prices. This has been the leading indicator of, pretty much the shortage that we have of homes in this country. As the pandemic exploded, so to speak, the demand for homes outside of, cities and major populated areas, it created a shortage of supplies again, and that includes real estate. So here the dilemma that we're dealing with. We're dealing with a shortage of soybeans. Potentially, it's trading soybeans at 16.53. Copper is trading at 4.77. And it's just a matter of time. It's just a matter of time before we see that adjustment take place in precious metals. The metals markets are the most undervalued assets across the board. If you take a look at the commodity prices in general, while commodity prices are exploding, crude oil and all the other commodities, the price of gold and silver, and I think maybe zinc or cocoa are in a negative territory. But particularly when you have this kind of environment with prices across the board exploding into an inflationary expectation or cycle here, I think it's just a matter of time before that falls into the market, and pretty much we begin to see the reaction, you might say, of that pent up demand that essentially will be looking at assets like gold and silver, which are, in my opinion, assets that I want to own. I want to trade virtual currencies. I want to trade coin. I want to trade GBTC. But in order to build what I am doing here, what I'm recommending, a long-term foundation, is to trade monetary units, in the monetary system, which is gold, silver. Gold and silver is real money. We have to come back to the reality that the US dollar is a fiat currency. And what we're seeing here is the awakening, pretty much, that fiat currencies are going to collapse, are collapsing, have collapsed against the gold, in particular the US dollar, more than 98%. And so in a paper fiat economy, which is loaded with debt, with paper fiat debt, so again, we're trading around the average price in gold and silver, and tremendous volatility. So what we want to do is maintain and hold our core long-term positions. And one way that I am managing the volatility is by using derivatives that are not on margin. I day trade, and I recommend my traders to use the futures contracts to day trade the market. Great opportunity to day trade, and some that can afford the luxury to hold on to it overnight on a swing. But the majority of the activity that I do and I recommend is for day trading the futures in the gold and silver markets, as well as coin. We're looking at a security, and of course GBTC, which is the grayscale Bitcoin investment trust. And personally, I don't need to be in 40 markets, even though we produced about 80 so algorithms. I don't need to trade all of them. It's a question of a personal choice that you want to have as a self-directed trader, that, once you decide on the sector that you want to trade, then you decide on the instruments, or you look at the instruments within that sector, and then you begin to analyze the risk of each of those instruments. Pointing case in the gold market here, the gold market, the gold futures market, is an indicator of pricing the future price of gold. It's called futures markets for that reason. But underneath that sector, you have derivatives. You have stocks, securities, ETFs. You have options on those instruments. So you have thousands of strategies that you can create. And personally, I am looking at the derivatives underneath the gold market, like GDX. Dust is a bearish XX ETF. Nugget, NUGT, is a bullish XX ETF. And I'm finding that it provides me with the stability, or the frequency, or what I would say is the level of risk management that I want to apply, depending on the instrument. Each instrument has a certain risk level. And so what you're doing is you're looking to see how you manage that risk, whether it's in stocks or, in derivatives, futures. And once you can see that, then obviously you can create a customized portfolio that would be a combination of all of them, and that will allow you to trade the market on a longer term basis, and hold on to it, to an asset. When I talk about ETFs, XX, XXXs, I talk about trading those instruments very, very short term. You don't want to hold on to them for a long term, but you can trade them, short term. The great trading instruments. So we are fluctuating, coming back here to the market, around the average price in gold, around the average price in silver, which is really an anomaly. When you when you take a look at the inflation numbers that came out. And this is what I said before, that the initial impact of rising interest rates is bearish for the gold market. And so short term, it may be that it is temporarily, but what we want to do is use these corrections we want to buy these corrections if given the opportunity, particularly into the buy one, buy two levels. Now, ideally, and when I'm looking at the markets here, and particularly gold down $9, down, silver down 21 cents on the face of this news is really incredible. And that is an anomaly. That's what I consider an anomaly. And I'm not so sure, once again, that this anomaly is going to be long lasting. So I want to buy and add into corrections in the metals, ideally into that buy one, buy two level, and ideally in a harmonic relationship where we get all of these trends aligned. But it seems that we're getting a bit of a sell-off here coming in, and let's see what it does here as we come into this buy one, buy two level here. Let's watch the market here for a little bit. There is really not that much action across the board. We've just come down in silver here to the buy one level once again. So this becomes basically a trade alert automatically the first time that the market comes down into the buy one level. It becomes a trade alert. And in using the 15-minute bar, basically on the close of this bar, it activated a trend alert. So using a conservative entry point, the close of the next 15-minute bar would activate a buy trigger. That would be at about 7:45. So this is a what I say, a prospective way to enter into a trade, to identify a trade. Right now, the first bar coming down is pretty much activating a trade alert from neutral. And it's telling you, listen, just pay attention. If we close above this level here in the next 15 minutes, you can buy at the market conservatively. Aggressively, you can buy on the close in about 5 minutes. If it closes above it, it's a bullish price momentum activating, and the trigger point basically is a close above it on the second 15-minute bar. And this is this is written in C++ in easy language. This is what I'm sharing with you, reverse engineering this process of the automation of this algorithm, which it is an algorithm. And what I'm finding is that by reverse engineering the algorithm the way I'm doing it and sharing with my traders and my a trading room in here with you, in this live broadcast, you can see the intelligence reverse engineered that makes the algorithm very effective. The difference is that by me controlling the application, it allows me to manage my account a little more exponentially, a little better by diversifying into other assets than just have the limited directional signal of an algorithm that says buy, sell, or buy the target and, your protective level. It's a one-dimensional instrument. It doesn't tell you how you can maximize and that based on your profile. It doesn't tell you how you can expand on the application exponentially. This is a test, once again, a contrarian test to everybody that was looking for the market to explode on the news of this economic indicator of inflation that came out. The market is doing the opposite. And, I keep saying the gold market doesn't trade on the fundamentals. The gold market is in a world of its own. And it's a technical world. And if you apply the fundamentals, it really does not fit into the equation of physically trading the futures markets with that fundamental information. You can see it's a contrarian information. The question is, what do we do with it and what the volatility does with it? So here is at 7:30 for aggressive traders. If the market in silver closes above 27.36, you can get long aggressively. Meaning it's an aggressive signal. And depending upon, again, your profile for managing the risk, you can either enter the trade at the market at, 7, we're looking at 7:30, the signal here. The close on this is 7:45. A close above, it's a bullish setup. It's a bullish setup. The thing that you want to watch here is, we want to trade, and so we got to take some risks, and I want to buy one at the market as an aggressive trade. And then if it comes down again into that 27.36, I want to pick up another one. But this volatility is expanding, and it's going to expand as we get more volume in this market. We could be up into a positive 30 cents by the end of the day for all intents and purposes, depending, just based on the volatility of this market. At 7:45, a close above 27.36 is going to activate a buy trigger in silver. If it closes below, you do nothing. You wait, you let the market confirm the trade. Selling between buy 1 and buy 2, it is the lowest probability for short positions. From B1, you're looking at a 50-90% relative implied volatility to the mean. If the market closes above it, confirms it, you're looking at a 90% probability that it will revert back to the mean. As you can see here, it's pretty much trading around the mean, and it's been trading around the mean until this incredible volatility came in. So, you know, you want to measure that volatility according to your profile. And if trading in the futures contract full size is too much, then you can initiate the micro. The micros in the gold markets are, I believe, 3-to-1. And in silver, they're 5-to-1. So you can buy, you know, 5 micros in silver for equaling the full-size contract. We're coming down into below 2736. So again, the close of 745 will be the confirmation of this pattern, and we'll see where it closes. That's going to determine basically the sentiment or the momentum, whether bullish or bearish. If it closes above it, it's a bullish momentum, obviously activating a short trigger for aggressive traders. You can buy at the market, you know, and for conservative traders, you can wait for the close of that bar to enter, and then measure the distance, you might say, of your entry point to give you a realistic risk-reward ratio. In gold, we have activated pretty much the same signal. So we're going to pick up an aggressive gold contract here as well and add to our position as the close approaches. So you as a self-directed individual, you can manage the risk according to your profile, whether you're conservative or aggressive, you know, and that's personal. Not every trader is homogeneous, and therefore you got to measure, you know, your comfort level in comparison to everybody else. So it's important that you trade comfortably, just in general. So coming back to the algorithm here, it's activating a buy trigger from 1823 in gold. And we're looking in silver here. Trading into the buy one level here. What I'm going to do here is I'm going to wait until the market closes above it to add to another contract. I'm going to sit tight with what I have, and I'm going to wait until the market closes above 2736 for me to add another contract. And this is pretty much the approach that I have and how I implement the signals from an aggressive to a conservative, you know, and following basically the signal, what the signal is telling us here. And what it's telling us is that we're in a bullish buy one level, which is a 50-90% relative implied volatility. And if we get the close above 2736 from the market confirming, then it's a buy trigger. It's a buy trigger. If it closes below, it activates a short trigger with a very low probability of only 10% from buy one. From buy two is 5%. So we're going to sit tight. We're not going to do anything here. And I'm going to wait for a close above 2736 to act on it. In the meantime, just hold on to it. Same thing for the gold market. just sit on your position for now and just let the market do and resolve this volatility here. But the algorithm has identified that 1823 is a buy level with high probabilities. Once the signal is activated, automatically your target above is activated. We're beginning to see buy-in come into the market, and this is pretty much what the AI recommends or suggests to you as a self-directed individual, that when the price comes down into that B1 level or B2 level, there it's ideally where it tells you where you want to see or expect buyers to come into the market. And what we're seeing here is pretty much buying coming in, taking all the selling pressure that you see from the previous bar, activating a bullish trigger and a bullish pattern. And we have pretty much the same thing happening here in the silver market. A close above this activates a buy trigger for gold and for silver, a close above the buy one level. It's getting very quiet, surprisingly quiet on the face of this CPI announcement this morning, that inflation is running at 4.2%. And I continue to, again, point out that the gold market and silver market trade contrary to the fundamentals. There's really not that much going on. It really slowed down tremendously here. We're trading below the B1 level here in silver, and pretty much gold and silver are holding these levels here, so it's pretty quiet. The E-mini S&P continues to trade on the downside here, so it looks like its bearish reaction is bringing the market down to the buy one level here, 4,100, and it remains to see what the market does from here. This is the first level of support. These buy two level is at 40.61 for the Dow Jones, and we have seen the equity markets pretty much come down quite a bit here from the high that was made here just recently. Yeah, the high was 43.28, and we seem to be following a bearish pattern here in stocks, but we've come down to some major weekly levels harmonically of support. And we're looking at maybe 40.78 to 40.61 as the market major harmonic level of support. So maybe another 20 points on the downside is going to tell us pretty much where the buyers are, or if they are going to wait for lower prices. So the mini also has entered a trade alert signal here that it's alerting you that we have come down to major levels, buy one levels. Silver is testing the lower levels underneath the buy one and fishing for buyers, basically. So let's see how far they can take this market down here. It's really nothing going on. It's very, very quiet. It's quiet before the storm, feels like it. We're starting to get some green bars, and so we want to just, let the market do what it's got to do, and for the algorithm, to verify or negate this signal. 27.36 last, and we're looking almost like a close. So I'm going to pick up another contract here in silver, and just sit tight and hold. By the way, when you enter into a position here, we give you 3 choices of stops. And don't use a straight stop until you enter a profit on the trade. Then you can trail the position with a stop. But use a dollar stop to keep you in. Otherwise, conservative traders can use a close below 1823 for you to get out. So you have a conservative stop, you have a dollar stop, and the third stop would be on the close below. On the close, at the end of the day, it would be the third stop if you want to carry the risk that much. Continue to hold your position here. We've covered our shorts in here, and the market is saying, you got to get long. And so we are going to follow the signal of the VCPMI, and that it's telling you pretty much to buy the corrections into the buy 1, buy 2 level, and measure the risk according to your profile in using any of the 3 stops. Thank you again for the opportunity to share this with you, and hopefully this trade will work out for you as well. Take care of yourself, and I'll talk to you next time. Be well.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Folks, John Najarian here with Steve Collegian, co-founder of Ticker Talker, and here we are in Master Control. And